Hey all, welcome to ShareTreck where science meets investments, and I'm your host Raj. Friends, today we are diving into a topic that's crucial for understanding the state of the US economy. In the past 6 months, the US has seen a wave of economic changes under President Trump's second term. New tariffs have been imposed on a wide range of imports, and immigration enforcement has intensified, leading to a notable rise in deportation and stricter border controls. These policy shifts are already making headlines as they ripple through the economy, affecting prices, jobs, and the strength of the dollar. Today, we'll break down the latest data and expert forecasts to see how these policies are reshaping the economic landscape in real time. Recent news reports show that tariffs are directly causing sticker prices to rise across US retail and manufacturing sectors. I'll give you an example. Nike reported a $1 billion financial impact from tariffs, and many distributors are re-labeling millions of products with price hikes ranging from 8% to 15%. Surveys indicate that over half of retailers expect average prices to rise 6% to 10% in 2025 due to tariffs. These cost increases are already feeding into higher inflation, with the OECD forecasting a spike to 3.9% by the end of 2025. As businesses and consumers face higher prices, demand is cooling, inventories are shrinking, and GDP growth is projected to slow sharply, almost down to 1.6% in 2025 from 2.8% last year. Stricter immigration policies and expanded deportations are beginning to strain the US labor market. Economists warn that the labor market, while still resilient, is showing signs of weakness with slower job growth and rising caution among employers. Immigration restrictions have already reduced the US labor force by about 45,000 workers per month since the late 2024. And predictions suggest a total reduction of 2.1 million workers if current policies continue. Industries such as agriculture, construction, and hospitality are especially vulnerable, facing acute labor shortages and upward wage pressures. And that will feed into inflation. Mass deportations could remove up to 1.5 million workers from construction, 225,000 workers from agriculture, and over 1 million from hospitality industry, with potential GDP losses of 2.6 to 6.2% over the next decade. The combined effect of tariffs and immigration barriers is a significant drag on economic growth. The OECD forecasts US GDP growth to slow to 1.6% in 2025 and to 1.5% in 2026, which is a steep drop from last year's 2.8%. Trade restrictions have driven the effective tariff rates to 15.4%, the highest since 1938, and are expected to reduce real imports by 7.1% and exports by 1.8% in 2026. Large-scale deportations could shrink the labor force by 1.3%, further reducing productivity and tax revenues while increasing costs for businesses and consumers. States with large immigrant populations such as Texas, California, and Florida are likely to be hit the hardest. The US dollar has depreciated sharply in 2025, falling more than 12% against the euro and over 8% against the Mexican peso and Japanese yen. And if you just look at the dollar index itself, that has dropped around 12%. This decline is driven by slower economic growth, trade tensions, and speculations about Federal Reserve rate cuts. American importers are increasingly being asked to pay in foreign currencies rather than dollars, reflecting waning confidence in the greenback's stability. Morgan Stanley and other analysts expect the dollar's weakness to persist, with the currency facing its lowest levels in 2 years as investors seek safer or more attractive alternatives abroad. With tariffs pushing prices higher and the economy slowing, the risk of stagflation, which is a combination of raising inflation amid stagnant growth, is growing. Inflation is expected to approach 4% by year-end, while GDP growth remains subdued, and unemployment is projected to rise to 4.6% in 2026. The Federal Reserve faces a difficult balancing act. Rising rates to combat inflation could further slow growth, while cutting rates might accelerate the dollar's decline. The dollar's safe haven status is being questioned as volatility in global currency markets increases, and more countries are moving away from dollar-based trade. So, friends, the latest data that I have seen shows that tariffs and immigration barriers are already reshaping the US economy, and I explained that to you. Prices seem to be rising, growth seems to be slowing, and the dollar is weakening. Economists and analysts warn that unless there's a policy shift, these trends could intensify, leading to more pronounced job losses, higher inflation, and long-term challenges for American competitiveness on the global stage. So at this point of time, if you look at Jerome Powell's situation, you can understand that he would be afraid about the inflation coming in due to the effects of the tariff, and at the same time, the tight labor market conditions that are likely to happen as a result of the deportation. And that's why when Jerome Powell was asked, would he have reduced the interest rate if it wasn't for Trump's tariff policies? He said yes, he would have reduced interest rates if it weren't for Trump's tariff policies. So that's the story out here, my friends. I'm working on a separate story on the US dollar weakness, and US dollar weakness has been going on since Trump's second term started. And to date, I think it has dropped around 12%. The DXY has dropped 12%. DXY is the dollar index, which is measuring dollar against a basket of currencies. And that a 12% drop is significant. And that could potentially, in my opinion, rise all the way up to 15.5% so that it can counteract the effective tariff rates and thereby to the level playing field and kind of bring an equilibrium. So that's the thesis I'm working on. Once I'm done with the video, you'll be the first to know because this is where I release those videos. So that said, I think this brings me to an end of today's video. And I would like to hear from you guys. Do you think whatever I'm noticing here is based on my media bubble, or do you agree with me that the US dollar is getting weaker as a reflection of the policies? Do you think the tariff policies are going to cause inflation? And how do you look at the market the way it is right now? It is booming. So I would like to hear from you. Any thoughts that you have in this context, please put that in the comment section, and I'll catch up with you again in the next video. Till then, bye for now.